All right, let's get started. Well, welcome. Thanks for joining us on 8 Drivers of Company Value. And today I want to talk about why we drive company value, whether or not you're considering selling your business or not. And the reason is that if your company is valuable to other people, it'll be operating in such a way that you'll be able to achieve the things you always wanted when you started your business, which is basically the freedom to do things your way, to work with and how and when you want, and then financial freedom. And so, as I said, the ultimate freedom is being able to scale your business, which you can do without yourself. It then enables you to sell your business or pass it down to family or sell it on to business people in your business, your employees, through an ESOP or something like that, or just remain as chairman and extract yourself from the day-to-day operations and become effectively what I call a coupon clipper and just collect the money it generates. So that is why you want to create a business that has value, because it will enable you to do all these things. The key, though, if you think about it, is for you to sell it, pass it down, or become chairman, requires you to become redundant. And one of the key drivers in all of this that we'll talk about is creating a method for you to become effectively redundant within the organization. So if we talk about value, in the M&A world, what we look at is what is the cash flow that the company is going to generate. Now, we use an EBITDA as a proxy for cash flow. It's fairly good. And so most people talk about EBITDA multiples. And if we keep this simple, we have a business that's throwing off, we'll call it company A, $200,000 a year in EBITDA, and it's trading at a multiple of 3, then the business is worth about $600,000. Now, if the owners of company A decide they really want to drive some value, they start working on it and they say, well, let's make our business better. So they increase revenue, which increases EBITDA, and they take it up to $240,000, a 20% increase. It's still trading at a multiple of 3, and so the value is now $720,000. $120,000 increase, nearly 25%, which is not bad. However, if we look at a different company, company B, that's generating $200,000 in EBITDA. But what they've done is focused on creating a business that has a lot of value. And so instead of trading at a 3 multiple, they're trading at a 5 multiple. And so their business is worth $1 million, which is a lot more than company A. Not only that, but if you create a business that has a lot more value and a higher multiple, it tends to increase your cash flow generation as well. So it's very likely such a company in the same period as company A that went from 200 to 240 would also go in EBITDA from 200 to 240. And if that is the case, it's still trading at a 5 times multiple. The value is then 1.2 million, which is a 500,000 or 70% increase in value. And that is just by focusing on the multiple, which is the key here and what we want to discuss. So if you look at the average business of businesses this size, which are typically sub 10 million in value, the average business gets a 3.55 times EBITDA multiple off it. However, Value Builder, who worked with over 14,000 companies since the 2000s, have found the companies that score 80 or more on their Value Builder score actually realize a multiple of 6.1 times, which is a 71% increase in value. So how do we get to that 71 increase in value? Well, the Value Builder system gives a score, as we just discussed, and we want 80 plus. And this is comprised of 8 different drivers, which we will discuss, the 8 different drivers, which come up with the overall score. And if you take your Value Builder score, you will get an overall score, but then for each driver, you will get your score plus an industry average, which is based on your NAICS code to show you how you perform, and also shows you where you can make the biggest difference. So the 8 drivers of company value are financial performance, growth potential, the Switzerland structure, the valuation teeter-totter, recurring revenue, monopoly control, customer satisfaction, and hub and spoke. And we'll go through these one by one. So if we look at the first driver, financial performance, we're going to say a financial buyer looking at your business, and a financial buyer is basically a private equity group or an investor group, and they're the most common buyers today. They're going to ask, how reliable are your projections of your cash flow forecasts? And how much cash will your company generate in the future? So to give you an example, if we have a company, again, whichever company, company X, and it's generating $1 million in cash flow, that's because the numbers are rounded into the thousands, and we decide that the investor wants a 15% return on his money, then he's going to divide the annual cash flow by 15%. So in the first year, that cash flow of $1 million is divided by 1.15, which basically gives you $870,000. For the second year cash flow, it's divided by 1.15 squared, and it's worth 750, and so on. And so over a period of 10 years, $1 million of cash flow every year is equal, in today's value, of about $5 million. However, a 15% discount rate is very low, and you'd have to be very certain about it. So let's say we're looking at another company, company Y, and the forecasts are not that reliable, and there's a lot more risk involved in the company. And so the buyer decides that he doesn't want a 15% return. He wants a 50% return to compensate him for the risk that he will take. Well, in this case, if we do the same math, you will see that that million in the first year is only worth 670,000. And in the second year, it's worth 450 as an approximate. So a 10-year period, the company discounted at 50% only got a value of $2 million. That's a 60% fall in value from a company that's discounted at 15%. Now, for small companies sub 10 million that are just an average, the discount rate you can expect to see is going to be somewhere between 20 and 30%. So as you can see, there's a lot of discounting that goes on. And the key to creating value is to reduce that uncertainty and make the numbers more reliable. If we look at the quality of your books, sorry, there's a typo there, the methodology, do you have accounting policies? Do you have budgets? Do you do variance analysis? And then do you take actions to deal with both positive and negative variances? Most people focus on the negative ones, but they don't do much about the positive ones. And that may be a market opportunity you should take care of. Do you follow US GAAP? Again, this is an area that causes a great deal of problems, as most buyers will say that they want a multiple of 3 times. They're willing to pay a multiple of 3 times US GAAP EBITDA. But most companies are not run according to GAAP. And so when their numbers are restated in a GAAP basis, they found their numbers have fallen, their EBITDA is low, and they're not realizing as much. The other thing is, when you do your financials each year, do you just produce a tax return? Or do you get a review or a reader statement or an audit opinion? Again, most of the companies in the size we're talking about, sub 10 million, do not need an audit opinion. But a review will give a lot of certainty to the buyer that your numbers are good. And finally, and again, apologize for the typo, it should be commingling. Many small businesses run personal expenses through the business to reduce their taxes, and it's easier. However, it's confusing. And if as a buyer, I come to meet you and you tell me your business is making $1 million in free cash flow, and I look at your books and you're actually making 200, and then you produce 15 pages of adjustments to tell me how you get from 200,000 back to the million, you're making my life difficult. And as a buyer, I don't have time to deal with that. There are too many businesses out there that I'm looking at, and I only want to deal with the ones that are easy. And so that's not good. Finally, a lot of small businesses tend to run expenses through it, which are not legal, basically tax evasion. I know of one company I dealt with many years ago in Tennessee, where the owner had built a house for his daughter and another one for his son, and expensed the entire building. This was tax evasion. The problem with that is it then creates questions about what else you're doing that are illegal, and most buyers will walk away. So the quality of your books are very important. If we move on to driver number 2, what is the growth potential of the business? Now here, we look at the growth potential matrix, and I'm going to pick a simple industry because you probably will understand it. But let's look at the photography business. And if we start off, we have weddings. Now, wedding photographers are skilled. They're known for the work they do. They charge a lot, and anybody who's paid for a wedding photographer knows that. The problem is it's an artistic business. You're buying that wedding photographer. because of the skill they have. You don't want somebody else who operates under that brand. You want them. They can teach some people in their business to shoot photos, but at the end of the day, not everybody can be taught it. So it has a teachable score on 1 to 10 of a 7. Valuables, a 9. It's got very high value, but it's not repeatable. And there's a season. So if you add all these across, you get a score of 16. If we then look at baseball teams of kids in T-ball and Little League and all those, that's pretty good because we can hire other photographers to go shoot them. So it's got a teachable value of 9. The value of it is a 3. Not everybody wants to picture their kid in T-ball. There are just too many sports, can't keep up. But it is repeatable. There's a different team every season. So it has a value of 21. If we then look at corporate events, what we have here is something that's less teachable. It's probably because of shooting corporate events and what they want. It's not like you can set up like a wedding, so you have to be very good at shooting on the fly. It has a high deal of value, like weddings. People pay a lot of money for the quality of the photographer, but they're not very repeatable. So it only has a score of 18. And then finally, if we go to school photos, those are very teachable. The issue is, can you get the kids in and out fast so they don't lose class time, keep it organized, and take pictures. The pictures do not have to be the highest quality. They just have to be good. So it's very teachable. It's very valuable. The parents buy them every year. And every year there's a new class. So it's great. And it's very repeatable. These pictures have been taken since I was in school. So I don't think it'll continue. So if you look at that, it has the highest score of 27. And so that is an area of focus if you do this sort of analysis. So as you look at your business, if you want to say, where is the growth potential? How do I create something that's teachable, valuable, and repeatable that will give me a high score? Now, by this, I'm not knocking photographers that do artistic work. I think they're wonderful. They just don't create valuable businesses. The next driver we're going to look at is the Switzerland structure. Now, the Switzerland structure is so-called because we are looking for neutrality, and we want everybody to be equal between our suppliers, our customers, and our employees. And in this instance, I'm just going to look at 2 customers. So if we look at your customers, what percentage of your business do your top 10 customers account for? Now, in an ideal world, it would be less than 25, but definitely not more than 40. More than 40 is a red flag to a buyer. They will discount and use a much higher risk premium on your cash flow, bringing down the value dramatically. The reason is if your top 10 customers account for more than 40% and you lose one, there's a big hit to revenue. So the more diverse your customer base, the less risk. With your employees, who's invaluable? Could you afford to lose them all? And 2, if you started your business again today, how many of your current employees would you rehire? Is this the team you need to get you from where you are today to a growth business? Or are you keeping a team because they came with you at the beginning, but they can't deliver? These are key issues. You want a team that can help you grow the business, but you also don't want to be totally reliant on one employee that if something were to happen to them, you would lose all the information in the organization. The next driver, number 4, we call the valuation teeter-totter. And this is a simple version, but basically we're looking at working capital needs of the business versus value. Now, when you sell your business, the buyers typically will look at what the average working capital needs of the company are. And at closing, there will be an audit done and to see if there's sufficient working capital to meet that average. If there's insufficient, the price is reduced. If there's excess, you get the excess. The problem is the more money a business needs in working capital, the more capital you'll need to grow it. So if you have a business that's requiring lots of working capital to grow, you may not be able to fund the growth. A business I knew, it was run by a friend of mine, grew from nothing to over 50, 60 million in 2 years, but was then shut down by the largest investor who couldn't take the hit anymore for the amount of capital it needed. So the key in the valuation teeter-totter is to focus on reducing your working capital needs and thus increase your value. There are a couple of ways to do this. One is your cash cycle. Looking at your cash conversion cycle, this is the amount of period from when a cycle starts to when it ends, and there are 4 of them. So the first one is the sales cycle. From when you start the sales process to the time you get the agreement signed or the order. The second is the make production and inventory cycle. How long does it take you to complete the work, basically? And if you do have inventory, how long do you hold it? The third is the delivery cycle. How long does it take to deliver the product? And that either be shipping or getting an appointment with the client to actually come in and deliver your report, etc. And then finally is the billing and payment cycle. Now, if you add up all these cycles, you get the amount of days from start to finish of your organization's cash conversion cycle from the time you started to the time you finished. There are three ways to shorten the cash conversion cycle. And they are, simplistically, you eliminate defects. Defects are a huge issue, both in production of goods and materials, as well as in production of intellectual property reports and work done by professionals. Typos and things like that, they have to be redone. So get rid of defects there. There are often defects and mistakes made in billing and payments. So if you can eliminate defects, you can shorten the cycle. The second way is just to shorten the cycle times. Sit down with your team and work out a better way of doing it. And then thirdly is to improve the business model. Now, the classic example here, well, there are two I'll go through. The first one is Dell Computers. When Dell decided to sell a customized computer to you, what it effectively did was it switched from saying, we have a line of computers in inventory and you're going to buy one, to you order it, we will then buy the parts and assemble it. Prior to switching their business cycle, their cash cycle was about 70 days. Following the switch, they went to minus 59. So basically, they didn't need any cash to grow their business. And they were using the customer's cash to support their cash flow cycle. Improving the business model is a great way to change your cash flow cycle. The second company I'll talk about is Costco. Costco was like a lot of the big box retailers, but what they decided was they would charge annual membership fees. And as a result, 70 to 80% of their profit comes from those annual fees, but it's a great generation of cash. They get that cash every year before you purchase anything. The second way to look at your cash is the power of one. And this analysis is quite simply going through the 7 items I will cover and saying, if they change by 1%, what would be the effect on our cash flow? So if you would increase price by 1%, what would happen to your cash flow? If you would increase the volume by 1%, what happens to your cash flow? If you increase your cost of goods sold by 1%, what happens to the cash flow? And so on. So we look at accounts receivable, accounts payable, inventory, and finally, overhead expense. And if you look at all of these and figure out what is the ultimate effect on your cash flow by a 1% change, then the one that has the biggest change is the one you should focus on, because that is where you'll find the most cash for your cash flow cycle, and thus make the valuation teeter-totter work in your favor. Driver number 5 is recurring revenue. And this has become more and more of a key item. You will have undoubtedly noticed that with any software you use, where in the past you bought a software package and used it. Now it's all done online through the cloud and you have to pay a monthly subscription fee. This is because the software companies are going for recurring revenue, which has a much greater multiple. But if we take a more simplistic business, let's say we have a security company and it does $1 million a year, but it does installation work only. It comes in and installs all the security equipment. That company would be valued at about $700,000. However, another security company does $1 million a year, but all they do is monitoring, monthly fee for monitoring. They'd be worth about $2 million because that regular income comes regardless, and most people don't cancel it. So it has a much higher value, there's much lower risk for the cash flows, and that's why. The issue, therefore, is to say, how do we affect our business model so that we can sell more things that are recurring revenue? That is often done through providing annual audits, continuous checking on systems, but providing some additional value amongst your product line to give the company continuous value that they'll pay for on a monthly basis. Driver number 6 is monopoly control. And what we mean by this is not that you're a monopoly, but how do you distinguish yourself from all the other companies in the market? And I often think of this as what Jim Collins referred to as his flywheel. What is it you do that you've perfected and you do continuously and continuously to make you better? So for example here, we're looking at differentiation. So if we take product differentiation, for example, you differentiate your product, which allows you to have higher pricing, which allows you to make higher margins, which allows you to have more money for product development, which further differentiates your product. A classic example of that is Giro helmets, Giro. They make the top helmets for skiers, cyclists, and things like that. They spend a lot of money to build the best products because they then give them to these athletes who use them and promote them. So it allows them to charge a much higher price for a quality product. They invest the margins in a product development, and so continuously build better products. And they stick at this cycle, and that is their differentiation. On a much more simplistic industry of a company I sold many years ago, we'll look at a wonderful thing called a tractor. Now, this tractor is manufactured by the company I sold many years ago called Valtra. It's a Finnish company. Finland's not the biggest company, but they sold tractors around the world. What you will notice in this picture is the tractor's orange. Now, here's the point I'm going to make. If you buy a John Deere tractor, it'll be green. If you buy a Case tractor, it'll be red. If you buy a Kubota tractor, it'll be orange. If you buy a Valtra tractor, it can be anything you want. What Valtra did was basically be like Dell. They said, if you wanted any color you want, you can have it. If you want any attachments added to it, you can do that. And we will add all the post-market attachments to the tractor when we manufacture, which reduces the cost. And finally, not only we will paint it any color, put any name on it, your favorite milking cow, your daughter, your wife, your favorite sports team, we will assemble it, and we can let you know the date it will be assembled, and you can come to the factory and watch us assemble your wonderful tractor, and you can drive it home. As a result, they had twice the margins of any other tractor company in the industry and sold for twice the multiple. So you can differentiate yourself. It's just figuring out how. But the more differentiated you are from the competition, the less likely it is the competition can take your market away, and the more valuable you are. The seventh driver, which is key, is customer satisfaction. Now, if you look at that, people fall in love with companies who have great customer satisfaction. The classic, I'm sorry if I lost you in customer satisfaction. I don't know what happened. We lost internet connection where I am. I apologize. I will keep sharing, and I will send out a copy of this later. So, reverting to customer satisfaction again, as I was mentioning, Patagonia is a company where people like what they do and put stickers of their products on the back of their cars. I don't see anybody putting stickers of companies like AT&T on the back of their cars. So the greater the customer satisfaction you have, the more companies are likely to do business with you, the less likely you are to lose a client, and so you get more value. So a way to measure that is the Net Promoter Score. And what we do here is we say on a scale of 1 to 10, how likely are you to refer us to a friend or a colleague? Now, on that scale, anybody 6 and below, we consider detractors. They will not recommend you. The ones of 7 and 8, they're passives. We will ignore them. And then those who are 9 or 10 are promoters. They will promote your business. So to get your Net Promoter Score, we take the percentage of people who are promoters, the 9s and the 10s, and we subtract the percentage of detractors, those who are 6 and below, and that gives you a Net Promoter Score. If we look at that for a couple of companies you recognize, Apple has a 70+% Net Promoter Score. People love the product. If we look at Amazon, they're nearly at 70%. People love Amazon. Great company. People love it. Samsung, they're over 50%, which is not bad. But again, people like it. Anything above 50 means more people like you than don't like you. However, the average is about 15%. So the question is, where do you rank with your customers? And what do they think of your abilities to provide services that they want? Testing your Net Promoter Score would be a great way to know how you rank. Finally, the last driver is the hub and the spoke. Here, what we're looking at is you, the CEO, as the hub. And are you in the owner's trap, where you do the selling, you offer too many different products, you're the only one capable of delivering, and you're the only one that interfaces with the customer? Because if you are, you don't really have a company, regardless of the size and number of employees. What you have is a job. And this is often seen when the fact that business slows down when you're away, Customers only come to you when something is wrong, and your revenue is plateaued. You can't grow the business. So the key here is to develop a management team that can truly understand what the business is doing and take out and continue it when you're not around. This is why we produce strategic plans, so there's alignment amongst the management team. And then the idea is to take that down to the employees so they know where the company's going and what needs to be done. I think one of the great things is that in this time of COVID, we have seen that companies have to pivot quickly to survive. If your employees understand what you're trying to achieve, then you can push decision-making down to them, which increases the decision time, and therefore allows you to respond much quicker to the market. So the key too here is the redundancy, which I mentioned in the beginning. What you really want to be is redundant. You want to extract yourself from the business so that you're not needed. And if you can do that, then you will not be in the owner's trap. This takes time and a plan, but it is well worth it. One of my clients once upon a time ran a business that took all his time, and he decided to work on this. And he ended up 5 years later, where he used to go out of town on Monday morning to his farm and relax and spend time there. Come in Friday morning, meet with the president of his company, get an update on the performance for the week and how they were doing against their goals. And then he'd spend the weekend socializing in the city with his wife before returning to his farm on Monday morning. He just collected the money. And because he had created such a good business, some private equity guys bought him out at a ridiculous multiple. That is a true sign of freedom. So that's really the 8 drivers of company value. And I would like to say, are there any questions? You can put them in the chat if you want to. I apologize for losing the connection earlier. I will be sending out a copy of all the slides to anybody and to everybody who was on the webinar. And if you want to follow up with me later, please do. I don't see any questions. I will say that if you want to get a score, you should get your value builder score just to see where you are. You'll understand what makes your company more valuable. You can find out where the hidden assets are, and also find the things you need to stop doing to increase its value. And to get your score, really, just go to the website below, https://bit.ly/3 small m, capital H, small c, capital W, small c, capital C. I know it's a bit short, but it's a shortened version of a long URL that you don't have to follow up. And if you get it, I will get it and then reach out to you and we can go through it. So I hope you found this helpful. I really appreciate you all joining me between Christmas and New Year. I want to wish you all a very happy New Year and all the best for 2021. And if I can help you in any way, increase the value of your company and give you the financial freedom and the freedom to do what you want and enjoy your business game, please don't hesitate to reach out. Thanks very much. I wish you all the best. Hold on a second. I've got, yeah, that's it. No other questions. Thank you, everybody. And I will send out a copy of this webinar. It may not be exactly this one since we lost the connection in the middle and that ended it. So, but it will be the slides with the voiceover as well. Thanks and have a wonderful New Year.